With hundreds and thousands of videos and blogs on different property strategies and making a case for why theirs are the best, you might be at a position where you're now feeling confused as to which one to pick for yourself. Now, trying to do everything not only will limit your wealth potential, but could actually destroy your savings and put you further back compared to when you started. So if you're just starting out or you've got 1 or 2 properties, this video will really help break through that confusion and give you clarity going forward. I'm going to reveal the pros and cons of each property strategy, give them a ranking, and ultimately help debunk any myths that there may be so that an investor of any level can move forward with clarity and confidence in their investment plan. But first, let me identify the ranking factors that I'm using to help assess each property investment strategy. Number 1, ease of understanding and implementation. So how easily is it to understand and how easy is it to execute and start from day 1? Number 2, already important, how much time commitment and resources needed in order to execute and maintain the momentum on this investment strategy. 3, the amount of capital required to invest, i.e. how much money do you need to have in savings or do you need to raise to invest in this property strategy. 4, and similar to the last point, is how easy is it to raise finance to support the growth of this investment strategy. Number 5, the risk of this property strategy. And number 6, actually the return and cash flow potential. Now I need to emphasize here, number 6 is usually the first criteria that a lot of investors, especially new investors, would use. Now the reason why I have that as 6 and not necessarily right at the top is because there's a philosophy that means that when you're investing in property, especially when you're new and you have a limited amount of capital, it's actually about having the mindset of how do I protect this and limit the downside. If you're able to raise 30, 40, 50,000 pounds every 1 to 2 years, then you can push this factor higher because you can replenish that capital quite easily. But that's not the majority of investors. It can take 5, 10 years to save that amount of capital. And as a result, it's about how do you protect the downside. And from protecting the downside, you can then move forward with confidence on pushing forward with the upside. So bringing all those factors together, I'm then gonna rank the investment strategies from A to D. A being the most favorable and D being the least favorable for a new investor. So the first one is a good old buy to let. So we're talking about renting it as a property or apartment to a single family user. Now for this one, it just hits all the factors in terms of it's easy to understand, it's easy to finance. The banks will give you easy amount of finance behind it because it's already proven concept. Now, the risk when it comes to this really comes down to location as well as proximity. So location in terms of where you invest in, does it meet the passive model? Watch other videos that I've got where I've described and explained our passive model. And number 2, proximity to you. The further away the property from you, the greater the risk will be because you can't just get up and drive there yourself. If it's a number of hours away, there's a higher risk if you don't have the right professional people around you, especially the right type of property manager and experts. So that's where the risk really increases. Now the return, there's a lot of people that do say, oh, buy to let is dead. I disagree. There's a huge amount of capital appreciation growth, prices are undervalued, and actually rents are going up significantly, generating really strong yields. You know, in the areas that we're finding for ourselves and clients, the yields are 9, 10% plus. Typically the returns are 10, 12%. And the amount of capital, this is where really the ranking really helps. You could be investing as little as 18,000, 20,000, 25,000 pounds. And when you're a new investor, that means if you've got saved 50,000, you can go ahead and buy 2 properties and you've already started your journey. And especially in areas where there's capital appreciation growth, you're then going to be able to buy another one a few years later and reinvest and go forward from there. So for me, I'm going to give this a ranking of an A, especially for a new investor. The second strategy is buy, refurb, and then refinance. So it's already a step up from the standard buy-to-let. You're buying it, you're going to refurbish it, you're going to refinance and try to pull as much money out. You're able to recycle your money quicker. So rather than, for example, sticking 25,000 in property, you're able to leave, what I will say to our clients, look to plan to leave anywhere from 10 to 15, 20,000 pounds. So you're putting less in the property over time and then allowing you to have that momentum to reinvest. So with typical buy to let, especially in our particular areas, it's 10, 12% as I mentioned before. Now, when it comes to buy, refurb, refinance, the returns are 15, 18, 20%. In some rare occasions, the returns are anywhere as high as 30%. Now, that really boosts this investment, especially when you're a new investor. But the risk is really high. Why? Because not only is it trying to pick the right locations, but the risk really comes down to the refurb. So the risk really comes in have you got the right type of refurb team? Have you got the right professionals that have got the quotes in, have done their due diligence, and that can deliver quickly? So this is not an easy task. You want someone on the ground, reliable, especially when you're a new investor, because they can identify pitfalls, but also identify areas where you don't actually need to invest in a significant amount of money, but will still boost the refinance value. Now, the second risk comes with a refinance element. What are the mortgage companies going to lend at? Now, there's no true crystal ball as to what the property will be worth. Why? Because from mortgage company to mortgage companies, their criteria on what they will say is the end value always varies. But here's where you reduce the risk. One, picking the right type of mortgage broker. They will know the lenders that work really well and what their criteria are. And number two, if there's a down valuation, they will help challenge that. Now, we had an example where we were refinancing a property and it was meant to be at 90,000. We then had the first lender come in and say it was only worth 75,000. Big drop. But then we went to another lender and they actually hit our target of £90,000. Now, we would have fell flat on our face, especially if we were new, if we didn't have the right type of mortgage broker that had access to different products and could also challenge the original valuation. So, summing it all together, the buy, refurb, refinance in terms of returns is higher than your standard buy to let, but it is caveated by the risk. But for a new investor, if you have the right team, the right strategy and the right locations, I would give this a A. So 3 is a HMO, House of Multiple Occupancy. Now we're going up the level in terms of complexity and understanding. This simply is where the property is rented room by room, as well as the factor that I'm making here is that there's not a huge amount of work to be done. It's already operating or just needs a light touch up, maybe a lick of paint. Now, the pros here are the cash flow and returns are higher, 100%. Your returns could be looking at 20%, 25%, and the actual cash flow itself, on a single buy-to-let or buy, refurb, refinance, you should be expecting £200 to £300 per property. Whilst on a HMO, your cash flow per month will be around 500, 600, 700, even all the way up to £1,000 for the right type of golden goose property. But here's the key things to consider, the cons. Number 1 is tenant profile. You could be renting to students, professional, or those on social housing benefit. Now, the risk varies, and in particular, no matter what type of tenant, there's always going to be a higher amount of voids and occupancies. Tenants move on. Whilst with a single let or buy, refurb, refinance, family will stay 10, 12 years. Whilst in a HMO, you'll be expecting a turnover of tenants every 6 to 9 months, meaning that the projected returns or cash flow is always lower because you have to factor in them moving on, finding a new tenant, as well as doing the maintenance and repairs to the room that they've left behind. On top of that, one thing to be aware of as a limitation is the amount of capital and the ability to raise finance. If you're brand new and you don't own any rental properties, getting a HMO mortgage can be really challenging. At the moment, there's only 1 or 2 mortgage lenders that will actually provide financing to a beginner investor. And number 2, the amount of capital you need to invest is far higher typically than a single buy-to-let. You should be looking to plan to invest 40, 50, 60, 70,000 pounds in that property. But when done right, it can work really well. Let's just give an example. We had a client who came to us. He'd actually bought several single buy-to-lets, who was now coming back to us wanting to just go up 1 level in terms of their growth in their portfolio, and they wanted a HMO. So they bought this HMO for 160,000. The property actually needed only 5,000 spending on it, and the property was rented room by room at £500 per month. So all in capital wise, they were only in for around £65,000. Their net rent per month was around £800, and that was a nice jump in their net cash flow compared to a single buy-to-let. So ranking this, I'm gonna give this a B, because as a new investor, the lending is limited when you don't have another property. There's a lot more expertise needed in it, as well as there's a lot more risk around the certainty of your cash flow. So next investment strategy is building upon the HMO, but now we're adopting, like the single let, a buy, refurb, refinance model. So with this strategy, you're going to be buying a property that's either a HMO that's up and running, but it needs a lot of work, it's tired, or it's going to be a property that you can convert into a HMO. Now, the element here is you're going to be spending a lot more money, maybe 20, 30, 40, even up to £100,000 on the renovation, and then you're going to look to refinance the property either on a bricks and mortar valuation or on a commercial valuation. So pros on this is that similar to a single let buy, refurb, refinance, you're able to pull more money out and then go again. And second of all, the cash flow, as you know before, is much higher. Rather than a single let being £200-300, you're still looking at £500-600 plus. Now, the limitations, especially when you're a new investor, again, is if you only own 1 or 2 properties, the ability to get the finance is going to be very, very tricky. 2 comes back to that refurbishment. Have you got the right team? Can they stick to their plans? And making sure costs just don't spiral out of control. And the next one is the refinancing. It's getting that higher valuation. Now, when it comes to HMOs, as I mentioned a bit earlier, you either have a bricks or mortar or you have a commercial valuation. A commercial valuation, generally based upon the amount of rooms and rent that you're making, will allow you to get a higher value than a bricks and mortar. But it can be quite challenging getting that valuation. And especially if you've done your numbers on that commercial valuation, a lot of lenders may revert back to just giving you a bricks and mortar, which could mean the numbers you were expecting and the money you were expecting back could be in real jeopardy. There's a lot of moving parts here. If you're a new investor and you don't have the right team, professionals who are doing it day in, day out, with the right financing team, the right refurbishment team, it can really be a huge mountain to overcome. You could do your first one, it could go terribly wrong, and not only could you lose the amount of savings you've got, you could actually be in the red. So when it comes to ranking this for a new investor, I would say be very, very cautious, plan well ahead, make sure you've got everything together, and bringing that all together, despite the amount of returns you get, I'm gonna rank this a C. Next strategy is lease options. So what is a lease option? Quite simply, it's getting a property and being able to control it. So rather than buying the property, you agree a certain price and term now, but there's no obligation to fulfill on that. So you're controlling the property, you're renting it out with agreed price that then allows you to benefit from the rent cash flow, and then at some point down the line look to buy it, but there's no obligation to. I've got several videos on the channel explaining it. There might be a pop-up that takes you to one of those videos. Go ahead and watch it and that will give you more full context. So looking at the ranking factors, For me, this one is superb when it comes to finance. Why? Because you don't need to go the traditional route. You're not buying the property outright, and actually you can get into a property with only a couple of £1,000. And that's why it really appeals to a lot of new investors. And on top of that, because you're putting a little amount of capital into it, your returns, when you factor in the rent you're bringing in, is going to be much higher than your standard property where you're buying with a mortgage. Now, that's the pros of it, but the cons of it are when it comes to implementation. Getting a lease option is challenging, and particularly you have to look at it when it comes to the circumstances. A lot of times it will either sit in two buckets. One, the property actually needs a huge amount of work and there's a lot of issues with it. Or the second of all, there's actually some kind of challenge around the owner and the landlord. Getting a lease option in your ideal location is pretty slim. The reason being is a lot of lease options are in areas where there's a high amount of crime, there's no growth rate. A landlord might have bought it 10 years ago for 60,000 and now it's worth 40,000. So they're now in negative equity. Their mortgage higher than the value of the property. So looking at those two buckets, I think as a new investor, if you can get into a property where it only needs a small amount and it's in the right location, perfect. But the challenge you have is, will you get that right type of investment? And could something that looks perfect on the outside turn into a mountain of issues? We've had clients back in the day who had invested in lease options that then became unstuck because they bought so many of them and they were in terrible locations. Locations where tenants were walking away not paying their rent. Locations where burglars were coming in. Some properties were even set alight. So if you're a new investor, not based in the location, and you're looking to buy a property in a very poor location and the property needs a huge amount of work, I would say, well, why not just take that capital, invest in a good location, in a good property, and just know you're on a steady footing. If later on, once you've built up a decent portfolio, you want to invest in some lease options, go for it. But you've already built up a really good, strong portfolio that then will allow you to protect against the kind of speculative investment in a lease option. So when it comes to ranking lease options, because of the risks around the location and the amount of capital, I'm gonna rank this a C. As a new investor, I think you have to be wary and again, make sure you're well educated and you've got the right team if you are gonna go down this route. The next strategy is investing in guaranteed rent, social housing. So with this strategy, you're going to be providing a HMO or a single let, and rather than renting it to your typical type of tenant, you're going to be renting it to tenants that are more vulnerable. That could be because they moved from one country to another, it could be because they've got a disability, or it could be because they're looking to rejuvenate their life because of prior experience and circumstances. So the positive here is the guaranteed rent. You know your money is going to be coming in, and a lot of lease providers will then take on the house, guarantee the rent, look after the property, and you as a landlord know that every month your income is going to be there set for the next 3, 4, 5 years. Some even go up to 10 years. But here's the cons, is when it comes to the guaranteed rent, maintenance and finance. Let's start off with guaranteed rent. Some contracts allow the lease provider to get out within 3 to 4 months, meaning your rent guarantee of however long isn't necessarily protected. 2, when it comes to maintenance, there's a lot of small wording and caveats that actually mean you as the owner or the landlord actually have to put money in to maintain the property after X amount of years and if there's other issues in the property. And 3, a lot of mortgage providers do not like to fund social housing properties. And those that do, a typical mortgage can be nearly double the price of a standard mortgage. So as a new investor, this can look good from the outset because of the guaranteed rent element. but the ability to raise finance can be challenging. And going back to the care provider, this is a big risk warning. There are some large providers who have a known history of actually upping and leaving the property in a poor condition, leaving landlords high and dry. We had an experience where we had a client who told us how they invested in the property with a nationwide provider, and after 3 years, the provider gave back the keys and the house was dilapidated. The kitchen was poor, the carpets were burned, windows were smashed, and they had actually recently refurbished it before. So just be aware of that when you go into it. Do your due diligence. So when it comes to grading this from an A to D, I'm gonna give this a B/C. If you can get the right type of provider, then I boost it to a B, but without the right provider and given the limitations around financing, for me it sits in a C. So we're now on to the last couple of strategies. So the next one is actually holiday lets. So sometimes it's called the Airbnb model, serviced accommodation, or alike. So what you're doing here is you're got a flat or a house and you're renting it on a short-term rental basis, maybe by the month, maybe by the week. And because it's being rented on a short-term basis, the rents that you can charge are going to be daily or weekly and far higher than what you would be getting on a monthly basis. So the benefits of this one is obviously a lot more cash flow. And I think you can never take away from that. But the cons you need to be aware of when it comes to holidays lets is the government is really cracking down on this. They're putting legislation in place that means taxes on this is going to be much higher. There are now councils that have put in place higher council tax and limitations on new holiday lets being allowed in that area. So the window of opportunity is really decreasing, and at an operational daily level, it can be really hard. You've got a guest who's coming in, their standards are going to be very high. And if you don't have the right type of property manager and the right type of refurb team, this is where it can be challenging, because your property and the demand for it is going to be driven by the amount of reviews you get. And if the reviews are dropping down or not high enough, demand will decrease. So you want to make sure with this, and one of the biggest limitations is the day-to-day. You have to have the right team, and there's a lot of cost involved. We'll give you an example with one of our properties. We had an 11 bed that we were doing a holiday let on. The income was really great, but we have charging from booking channels. We had high cleaning bills, higher maintenance costs that actually, after all of that, we were just about making any money. So we actually reverted that property to a HMO. So given our experience and given other experiences, I would say this can be challenging. And what's typically happened recently, a lot of flats that investors bought for serviced accommodation are not necessarily performing as expected, because the flats can be easily replicated. Another investor can have the same flat in the same block, another one in another block, and so on and so forth. That means that there's more competition, causing less demand for your property. So as a new investor, I think this does have a higher return, but the risk is much higher and there's a lot more opportunity for this to go wrong. So I'm gonna score this a C because of the amount of time commitment needed and the level of expertise. You can't just come in and operate this because there's a number of nuances involved. So now the last one is land development. So that is taking land, buying and building a brand new house or block of flats. The cons are it's a high amount of experience, you need a lot more capital involved, and given that interest rates have jumped up, it's higher cost of financing. As a new investor without the right amount of experience, this one's harder because you can start today, but when you factor in planning permission, build out, as well as when you come to sell the properties, it could be nearly 2 to 3 years until you see a return. So as a new investor, I'm gonna rate this a D. And the next strategy is flips. So you're buying a property that's in rundown condition, you're touching it up, you're sprucing up, and you're then looking to sell it for a profit. I like this strategy because of the amount of return you can get. You could be making as I mentioned before, 15, 20,000 pounds plus, and based upon the amount of capital you invested, your returns could be near enough 30, 40, 50%. Now, the challenges all come back to when it comes to what's the end value and the refurb cost. So similar to the buy and refurb refinance model, that refurbishment element has a lot of uncertainty around cost and quality, because the end user will come in and they want to make sure that it's looking good, but there's an element of quality and standard and care being taken. So that creates a risk around that. And also, what is the end value? Where there's a market where interest rates are higher and buyers aren't as strong and in abundance, guess what? That could have an impact on your ability to sell that property, because buyers are going to look to negotiate that down because they've got more options. So I'd say a buy and flip is really good in a market which is stable or going up. But when the market's changed and money isn't as free flowing, flips isn't the right type of strategy. So for a new investor who only has 1 or 2 properties, or it's the first one, I would say maybe put this in the back burner, or look to maybe partner with someone who does a lot of investments so that you can learn from them. So ranking this strategy, I'm going to give this a C for a new investor. So I've gone through all those strategies, I've given it a ranking, particularly focusing on whether you as an investor are new to the industry and the amount of experience and capital that you have. So there's going to be a table that comes on the screen that's going to be putting all those strategies in one clear ranking order so that you can reference that quite easily now or in the future. But it's all well and good knowing which investment strategy to focus on as a new investor. But the challenge comes in with trying to find the right type of properties and who to work with to identify and secure those investments for you. There's a lot of professionals out there selling coal painted in gold. Watch this video on how to make the right choice and choose the ideal property sourcer to build your property portfolio.